Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. Coming up on the show today, John Zechner. He's the chair and founder of J. Zechner Associates. He'll be joining us for the hour. In 30 minutes, construction company AECOM posting a narrower loss and higher revenue, though, for the first quarter. We'll talk to Maxime Sichev, Managing Director of Industrial Products at National Bank Capital Markets, for his take on the company's performance. And, of course, we want to hear from you this morning on First Call. Reach out with your questions on North American large cap stocks, and we'll have John answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. The phone line's open about 30 minutes from now. And our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The federal government's spring economic update is lowering the projected deficit by almost $12 billion. However, the figure is tracking to decline only nominally in the years ahead. The extensive 167-page document features several measures, including investing billions in training and recruiting skilled trade workers, millions on Canadian athletes and sporting events, and reducing the Canada Pension Plan contribution rate. And we are looking ahead to a policy decision by the Bank of Canada this morning. The BOC widely expected to keep its benchmark interest rate unchanged at 2.25%. The bank has been grappling with numerous factors that have clouded the outlook for inflation and the economy. In addition to trade uncertainty, the war in the Middle East has added more ambiguity to economic outlooks. Shares of Visa are up in the pre-market. The credit card company top profit and revenue estimates for the second quarter. Visa says resilient consumer spending contributed to the upbeat results, with particular strength in consumer payments, commercial and money movement solutions, and value-added services. Analysts note payment volumes are showing signs of stability. And now our top-line story. The federal government is using greater than expected fiscal room to step up infrastructure spending, unveiling plans for a new sovereign wealth fund to back domestic projects like pipelines and ports, alongside major investments in skilled trades. Stronger revenue from high oil prices and revised GDP data are allowing Ottawa to spend more while slightly lowering deficit forecasts. Let's get some key takeaways with Derek DeClute, executive editor for Canada at Bloomberg News. Derek, thanks as always for joining us.
Good morning.
Is the deficit reduction, is that the one that stands out the most to you?
Well, it stands out in the sense that it makes last year's books, the year that just closed on March 31st, look a lot better. And there's a couple of things behind that, but really the big one is the economy is a little bit bigger than everybody thought. You know, all these things are sort of based on estimates, and as you see the growth come through, growth was not so bad. Last year was kind of a bumpy year, up and down with the trade war and so on. But at the start of this fiscal year, April 1st, you wound up with GDP being slightly higher, and therefore government revenues are higher. Obviously, oil, the oil shock recently, sort of helps with that. And the longer that goes on, that's going to help certainly regions like Alberta and Newfoundland. But I think what was a bit just as striking to me is the fact that while you have these higher revenues this year and in the years ahead in the projections, really the government has decided to allocate or spend most of that either on program initiatives or tax reductions. The fuel tax this year, the recent break that was announced being one example of that.
And what are some of the programs that are going to benefit business?
Well, the real highlight, the real sort of new thing in yesterday's document is about skilled trades, about trying to get tens of thousands of more people sort of trained up, particularly younger people, to be electricians and carpenters and so on for the building boom that the Carney government is trying to generate. You mentioned the Sovereign Wealth Fund. That was sort of the big announcement on Monday. And obviously the government's big theme is building. I mean, it's even in the tagline, build Canada strong. This is what the government is trying to make itself all about. So what's the sort of HR or people component of building is you need people to do the work, and it's very clear that with the sort of sharp reduction in immigration and temporary workers, part of that is going to choke off some of the potential labor that you might need down the road if you're going to build more houses, more pipelines, and so on. So that labor has to come from somewhere, has to be generated more internally from people who are already in the country. And the skilled trades program, I think, is kind of the idea behind that. So it's partly a thing that exists or that is coming to exist because of the emphasis on construction and the emphasis on infrastructure. And it's partly, I think, a little bit of an offshoot of the change in attitude toward immigration.
And a couple other things, CPP they're going to drop, but one of the ones I found interesting, they're trying to get rid of that backlog for air travel complaints, which I'm sure a lot of travelers would be happy to hear.
Yeah, that's right. I mean, the transport minister wants to use a different structure that may allow these complaints to be handled by basically third-party arbitrators, as opposed to all being funneled through the existing system, which has proved to be a bit of a choke point. I mean, in financial terms, that's not really that significant an item, but certainly, as you say, for consumers who are frustrated by the time it takes to get their complaint with Air Canada or other airlines resolved, this would probably be a welcome thing. I think you're going to see other little things like that the government will try to do just to sort of make the processes that government has set up over time a little bit more efficient.
All right, we've got to wrap it up there, Derek, but thanks as always for joining us.
Thank you.
Derek DeClute is executive editor for Canada at Bloomberg News. Let's bring in our guest for the hour, John Zechner, chair and founder of J. Zechner Associates. Talk a little bit about what we saw yesterday, but you also want to talk about what lays ahead today.
Yeah. No, I mean, the report on Canada, there's nothing really surprising in there. The deficit spending is going up. Yeah, oil going higher is certainly helping us in the short term. And the economic data, let's face it, Roger, has been stronger than a lot of people, myself included, would have expected given the tariffs, given the war, given everything else. But, the consumers continue to spend. The U.S. has continued to be strong, which still helps us. And a lot of our trade has still been insulated because of the USMCA from these tariffs. So that's been, that's been more of a tailwind, and fiscal spending, obviously, as well. So that'll continue. And it's logical the way they're spending, infrastructure, productivity improvement has to be front and center. I mean, we've had 2 decades, as you know, of decreasing productivity in Canada. That can't continue. So we've got to improve that a level. Some of that is capital spending, and some of that is sort of skill training on top of it, too. And you throw it into the mix as well when you see some of the announcements of some of the tech companies and others recently about pretty substantial layoffs. There's out at Rogers Weeks and everything. As people, what is the impact of AI and what will be the impact of AI be on hiring levels in general? So you've got a real mix of things going on here. And I think what the government is doing makes sense and is sort of the way to go. I mean, it's hard to believe that, these deficits of, $60 billion plus or whatever, just, you got to finance them to a point. And in the U.S., you're running 6% deficits ongoing in a period of economic strength, which, again, is unheard of doing this outside of a wartime or recessionary times. But, the spending pumps are wide open, so it's a tailwind for the economy. At some point, there's going to be after reckoning of how does this all get financed and paid for? But, maybe that's what the gold market is telling all of us all along right now by the strength there.
All right, let's look ahead now. We've got both the Bank of Canada and the Fed today. What are you expecting from them?
You know what? This is really about really nothing.
Seems to be
I mean, 100%. There's going to be new move, and it makes sense. I mean, inflation's a little bit higher. There are economic growth risks, but you don't know what's going on with the war. So, the old thing, when you don't know whether to move forward or backward, the best thing to do is just stay where you are, and both central banks are going to do that. The more interesting story today will be the Fed, because this is obviously going to be Chairman Powell's final meeting and his final press conference. What's he going to say when he'll get asked questions? Are you staying till the end of your term in 2028, or are you leaving after this? And we have no idea. I think he's got to answer that. So that the shakeup at the Fed and the ultimate direction of the Fed, and Warsh getting approved, and will he change things? Will it be a Trump acolyte, or will they maintain their independence? Those are the bigger questions going forward. Those won't get answered today. So that, again, given 2 rate decisions, that's not the lead story today.
Yeah. Can you see Powell staying? Would he want to stay for another almost 2 years?
I think to a degree it wouldn't surprise me if he did. I mean, he cares about the Fed's credibility, and I think he wants to stay there to make sure it's in place. And he doesn't have to lead; have to be forced out. And I think he cares about. I mean, that's his legacy a little bit. The way he's in effect stood up to Trump, the way he sort of held tight on rates and his view, and I think he wants to continue that going forward. So it wouldn't surprise me if he stayed on. No.
All right. And also, probably more important in some ways, some earnings reports coming up, big earnings reports.
Rogers, this is the Super Bowl of earnings. Like this is unheard. Like the idea that 4 companies alone with a market value of $12 trillion, that's, like I can't believe we're talking about numbers, and they're all reporting today. Now, but not only that, these are 4 of the most important companies in terms of some of the major stories, the major themes underlying the moves in the markets, over the past couple of years. So, 2 things in particular I think you got to watch for in the reports is one are the capital spending plans. These 4 companies together have currently expected around $700 billion this year in capex, up from
it keeps going.
Keep going on, but that's $450 billion last year, which again was an astounding number. So, does that spending actually go up again? That'll be the bigger question. And that's a bit of a worry because obviously investors were not liking the idea that they're generating negative free cash flow. You're spending so much and they have to spend even more. We know there's, the compute deficit, so they need to keep spending more. That's what the semiconductor companies and all the infrastructure companies are telling you. But, will they add to this? I think I'd be more pleased to see them just hold the level now and not increase it further. The second thing you're going to watch for, and again, these are 4 great litmus tests for that, an indicator, how well are companies monetizing AI? And again, 4 of the best companies, because you got the 3 owners of public clouds, obviously Google Cloud, Microsoft Azure, and AWS for Amazon. Yep. And then Meta doesn't have a public cloud, but they have their apps, and they're the biggest generators of online advertising next, along with Alphabet, Google. So that'll show you how well are these companies monetizing into their client base? Is their growth showing overall? Because that is a real big question. It's one thing to be spending all of this money and generating the negative free cash flow, if on the other side you're generating, increasing revenue growth. And last quarter was a classic example. I mean, Azure growth for Microsoft was supposed to be around 40% annually. They came in at 38%, and the stock got hammered that day. I thought, wow, that's a high bar.
So, is there any chance investors could be happy after 4:30 today? No matter what would they have to show?
Well,
that would be the perfect one. Everybody says, "Okay, we're good."
You know what? From my point of view, maybe I'm talking my own book a little bit. I'd love to see them hold the line on the capex a little bit, not continuing to spend, and then just show decent growth in the cloud businesses and overall, their applications growth and other things that show they are monetizing AI properly. You do that, I think you'll get a hefty sigh of relief from markets, and the valuations of these companies are reasonable, especially compared to the rest of the market. And you realize that tech companies are generating almost all of the growth in the economy right now.
All right, we're going to wrap it up on that note there, but lots up ahead, including Canadian energy could be on the verge of a major reawakening as foreign capital returns and geopolitics reshape global oil trade. More after the break. Canadian energy stocks are undervalued, are starting to draw renewed foreign interest as global investors rethink risk and supply. A potential bid by Shell for ARC Resources, rising long-term oil prices, and growing infrastructure investment all highlight the long-term value of Canada's energy assets. For more on this, we're back with John Zechner from J. Zechner Associates. John, you're liking what you're seeing there?
Yeah, I think investors should not underestimate the importance of that bid by Shell the other day to buy ARC Resources. Quite honestly, we have seen nothing for the past, since 2014, I think, effectively, but an exit of money from Canada in the energy sector. It was ESG concerns, companies just getting out of, carbon fuels in general. Southern Norway, guys like that got completely out. Idea that they didn't like heavy oil in particular, or dirty oil as they called it, or whatever, even though it's long life reserve. Lack of infrastructure spending here, so how are we going to get the product to market and all that? And that led just money going out and sales of assets, and the Canadian companies were the buyers, and they kept bringing it in. Now, big change in this situation. I think what's going on in the Gulf region has heightened everybody's the importance of geopolitical risk, and how critical they are in looking for areas that have less geopolitical risk. And boy, does Canada ever stand out on that one? Our heavy oil is suddenly, has been in more demand, obviously for refineries in particular, and for jet fuel. And maybe more of that will come out of Venezuela because they're the other big producer. But for now, it's in demand. And the infrastructure spending, getting more of the support, whether it's, we get it to LNG, whether we're getting more gas pipelines, however we deliver it, to see that we're actually spending on the infrastructure is going to make these investments more worthwhile. So I think you're going to start to get rid of that discount you see. And I think when international investors are going to look more at Canada, get it back on the radar screen. And so far, Canadian Natural Resources, Suncor, to degree, have been sort of the big plays for the bigger guys, the big liquid stocks. I think they'll look beyond that. I think the ARC Resources is a classic example of that this week. A name like Cenovus stands out to me as incredibly cheap. The timing of their buy of Meg Energy, is phenomenal in retrospect. Now, they couldn't have got it, I think they got it at a decent price, but obviously they got it at a time when everyone was looking at $60, $65 oil at best. And I think now you're looking at longer price. Now, it may not hold in oil.
What do you think with longer prices? I think 80?
Yeah, I think it's something more, in the 70 to 80 range is longer term. I think what's interesting is when you look at the oil curve, what's going on there, that tells a bit of the story. When the crisis started, when the war started, the front end of the curve jumped to 110, 120. Yeah. It got way up there, and then it's pulled back. But the back end of the curve didn't immediately jump, but it's been slowly moving higher and higher. You look at futures a year out or something like that, and they, like I say, they didn't pop up immediately, but they sort of moved into the 70s, but they've held that range and sort of, moved marginally higher. And that tells you a bigger story about what's happening in the physical market. The shorter term market is driven by financial players. And they're, the fast money, the hedge fund, and all of these guys, they're in and out, and they'll play that at the front end of the curve. The back end of the curve is going to be more the guys who are going to have to take delivery and need this production, and that's telling you a better story. So yes, I think you can sort of say, we're looking probably a price around $75 more as a longer term average. At that, Canadian companies look exceptionally good.
So Cenovus is one. Any others that are kind of standing out?
Canadian Natural is still a great play. Tourmaline, nothing. All I ever see is insider buying on that company. Whitecap Resources, again, the timely buy of Varen or the old Crescent Point, light oil, Montney, Duvernay base. It's great assets there, good management team. So I just think all of these things are going to get a better look, and they've had discounted valuation. I think that'll disappear a little bit. So,
what do you think is a big potential stumbling block? Is it politics? And different provinces wanting different things?
I think the global picture is more of it. Let's say, you get a settlement for some reason that the Strait of Hormuz is suddenly open again, and these things are flowing. You get more like the UAE the other day, sort of pulling out of OPEC,
right?
And you get suddenly Russia wants to put more production out there. There is a lot of production that could come back online if Venezuela sort of fixed up a little bit. So, that would be the supply side. And at this, on the other side too, you get a little bit of demand destruction at these higher prices. But, I don't think those are huge risks on either side. So, but, that would probably be more the global geopolitical, more as opposed to anything domestic.
The danger being people just forget what happened in the Strait of Hormuz, and they just go back because it's easy,
exactly,
it's simple, it's there already. We don't have to do any building.
They're always looking ahead. The Strait of where, it's whatever. It'll become that again. And but I just don't, I don't know. To me, this is a little like what 9/11 did to air travel. It was never quite the same after. It'll recover. It'll get better. But there's always something else. And I think, politically, geopolitically, oil is probably going to go through that, but people are never going to look at global supplies in the same way, in the safety of it in the same way.
All right, we got to wrap it up on that note there. But up next, we'll be back with John to discuss where he sees value traps in the areas that remain growth stories for investors. That's after the break. All right, let's see what's on the radar for John Zechner, chair and founder of J. Zechner Associates. And he says investors need to be wary of the so-called value traps and broken growth stories. Well, chasing the dream, right?
Yeah, it is a little. And I mean, every active investor, and myself included, and I think most people are probably more active in investing than they say. Not everybody is buy and hold forever, but everyone who does that always you love to buy things at a discount.
Of course,
when they're falling,
buy low,
cheap.
sell high. It's the classic.
Exactly.
Right?
You want to pick up, and especially stock falls a long way, and hey, it's trading at 100 now. It's trading at 60. I mean, maybe it's a buy, and I think what you got to be very careful of is what we call value traps or broken growth stories. Effectively, as something ends, the business will never regain what it was. The growth profile will never come back, and you end up chasing it. It's cheap, so you buy it, and then it comes up with another disappointment. It drops a little bit more. It's cheap, but it's lower, and you say you got to be careful of that. But on the other side, you do get the opportunities, and this week was a classic example. Intel. I mean, look at the move in Intel in the past year. I mean, that had been a dog and an under for 25 years, ever since the peak at the bubble in 2000. They had never come back to those levels, and so it was such a broken growth story. But you get the right turnaround in a short period of time, and obviously government support and a few other buyers, you can make a recovery. So yeah, we're always looking for those kinds of things right now. So I start to see are there broken growth stories that are getting turned around? I think telecom is one. Mm-hmm. I think, again, just like you're talking about ARC and resources and Shell on the oil side, I think what Rogers announced last week on CapEx is significant. If they can't grow, I mean, slower growth overall, and you still have cash flows and you still have good business, why keep spending all this money on capital expenditures and building up your networks and all of that if you're not getting a return on it? Instead, cut that way back. So your free cash flow goes way higher. Give that back to shareholders. Give it back. Higher, increase your dividends. Do buybacks. Pay down your debt. And I think that mentality is going to start to grow through the telecom sector. So yes, it'll be a slower growth industry, but it's at a lower valuation. More cash will accrue to the shareholders, and that'll be a benefit. Much like tobacco was a non-growth industry for decades, and yet the stock still did phenomenally well because they gave that back to the shareholder. They took some of that and reinvested in growth businesses. So you can take that.
What are you looking for then when you're seeing companies that are down? What are some of the indicators?
Well, valuation is always a good starting point, but it's never enough. You got to look for a growth to return at some point, or the decline to stabilize. I think we're sort of seeing that on telecom. The other area is software, where everyone worries because they think it's future, it's coming, it's going to be decimated by AI, and you're going to see continue write-offs of application softwares and ERP and everything else. I mean. The ServiceNow earnings, which actually weren't bad the other week, and then the stock got hit pretty hard just because their average, run rate of revenue didn't grow as much as maybe desired by the market. So we got to look for those. I think those are opportunities, but what you've got to look for is the business decelerating? Is it diminishing? Are you actually losing market share to new competitors or something else? It's not just cheap is not
always a deal.
Enough alone, exactly.
Yeah.
So you've got to have something else. You got to have a way to reaccelerate growth or get money back to the shareholders.
And are there clear red flags on some things?
That's an unknown at this point for me. Like I can't. I want to watch for the next couple of quarters. They're cheap enough that I've starting to put some in the portfolio. And Constellation Software up here, Salesforce we've put in. I'll take a run on Adobe even. But I'm pretty wary that if you start to get a deceleration in growth or even slower, that these valuations are certainly not going to go higher. So you got to be wary of where it is. But I think they're cheap enough to justify taking a position in them because they may incorporate AI better than anyone. They're at the front end. It may be easier for their clients or customers to do it within the framework of these applications as opposed to sort of doing it yourself.
And and you would expect that they're looking at AI going, how do we incorporate it? Can they all survive though if AI does as much to software as we think it may do?
No, and that's what the sector got hit again a few weeks ago when Anthropic sort of said they've got an annualized revenue run rate of $30 billion, really an ARR of 30 from up $3 billion a year ago. Okay, that's got to be coming from somewhere. Is it coming from the software vendors? Is it overall industry growth? And then we found out the other day, well, maybe some of it's coming from OpenAI not growing as fast as they were before. So there's going to be a lot of balls in motion here, Roger. So I think there's a lot. The spending is going up generally. The profits will be going up as a whole. You've just got to sort of, figure out the right horses along the way. And I sort of like playing some of the laggards, some of the cheaper stocks, as long as, they will have growth profiles still.
All right, we'll wrap it up on that note there. But still ahead, we'll be watching shares of Aecon Group today after it reported a record backlog. We'll find out why with our next guest. And our phone lines will open soon for our first call segment. Call us at 1-855-326-6266 or send us an email. First call at bellmedia.ca. Canadian National Railway missed profit and revenue estimates for the first quarter. The Montreal-based firm saw revenue growth in petroleum and chemicals, intermodal transport, and grain and fertilizers, while metals and minerals, forest products, and coal saw a revenue drop of 10% or more. CN Rail mentions ongoing uncertainty in the macro environment impacting performance. Second quarter profit for CGI matched analysts' estimates. Revenue for the Montreal-based company grew annually on favorable foreign exchange movements, but it came slightly below expectations. The IT and business consulting services firm credited its performance to its AI-first strategy and clients' continued investment in AI. CGI's booking fell by a little more than $150 million, while its backlog climbed. Health Canada has approved its first generic version of Ozempic. This paves the way for cheaper access to popular diabetes and weight loss drugs, the federal department says. It is currently reviewing 8 other submissions for generic semaglutide by different companies. Semaglutide is the main ingredient in Ozempic. Launch preparations are underway, but a time frame has not been provided. And a quick look at the markets. A mix. Off slightly with the Dow, and Nasdaq's up slightly, and the S&P 500 off slightly. They're all in that 0.12 to 1.5 range. I think everybody's just waiting to see what happens at 4:30 today. We'll see. The Toronto-based construction company Aecon reported a record backlog of nearly $11 billion. It expects 2026 revenue to exceed 2025 due to its backlog and other factors. Joining us now to discuss this and more is Maxime Sichev, Industrial Products Managing Director at National Bank Capital Markets. Maxime, thanks as always for joining us, sir.
My pleasure. Good to see you.
Record backlog, but they also they had a loss in revenue. What unfolded for them this quarter?
Yeah, so backlog is up 12% year on year to almost 11 billion. Revenue actually increased 18%. And given the seasonality dynamic, just because, again, we're talking about Canada, typically there is an EPS loss which was in line with the estimates. But typically the market pays much more attention to the EBITDA, and that number specifically beat. It was at 32 million versus consensus at 27. So it was an overall a very, very strong quarter, Roger, to be honest.
Hey, Maxim, good to see you. I've always saw this has been a cyclical industry and a cyclical stock for a long period of time, but they've had a fantastic run over the past, year in particular. But I always wonder, because they were more sort of, as opposed to the engineering companies where it's just a fee for service, they always had the long-term fixed price contracts, which are always risky because you have to observe cost. Is that still the bulk of it? Is that still a risk that we're still going to get those lumpy earnings from Aecon that they're more driven by how well they can do on any specific contracts, or are they smoothing that out a little bit more?
Yeah, John, that's a very good point. So there's 2 things that have changed. One of them is the fact that the company has significantly de-risked its contractual profile by doing less of these lump sum turnkey projects. So that, by definition, over time will de-risk the probability of sort of any hiccups. And to your point, you're absolutely right. Eglinton and a number of other LRT projects completed, and so right now we only have one lump sum contract left, which is Gordie Howe, which is actually going to be done in Q2 of this year. But the other critical dynamic, which is important to mention, is the fact that the procurement methodology in Canada specifically has changed completely. Back in the day, it's going to be a beauty contest between 3 or 5 companies, who are going to be asked to do a proposal for an LRT program. And you, as a construction company, without having done full engineering, have to give a firm commitment to how much it's going to cost to build like a transportation line. In hindsight, obviously, it doesn't make a huge amount of sense, and that's actually what led to cost overruns and frictions between the clients and the construction industry. But right now, that methodology is no longer applied. So typically right now, what we're facing is a much more symbiotic relationship between the proponents and construction companies and engineering entities, where the full project is being de-risked as soon as the contracting entities and the proponents decide which team they want to work with. And only once of engineering and et cetera is 100% finished, that's when these projects kind of flipped into fixed price. But so that's a dramatic shift, I would say, over the last 5 to 3 years. That significantly reduces the possibility of any type of negative surprise on a going-forward basis. So that's actually why the structure of the industry is so much better right now versus, I would say, at any point in company's history.
So it sounds like you like what they're doing with that. Do you see any other changes that might make it a little smoother?
Yeah, absolutely. It's also about end market exposure. So right now, nuclear is 28% of companies' top line. Utilities is another 18%, and these two end markets are growing very rapidly. Obviously, in Ontario, we're waiting to see what OPG is going to do when it comes to technology selection, et cetera, and the same thing with Bruce. But what's critical with Aecon is that they're completely agnostic when it comes to technology selection. So whatever decision is going to be undertaken in Ontario, Aecon will build it. Utilities obviously is a very robust market right now, especially in the U.S. And I mean, the company has been scaling up its M&A in that geography over the last couple of years. Actually, utilities right now represents $1 billion worth of revenue for Aecon. So I mean, already within, I mean, Aecon is a large company to begin with, but utilities itself is a standalone $1 billion business. So it's really the composition of forward exposures which makes us, very excited about the prospects for the company. So it's both contractual structure differential, but also the growth curve optionality that we see for the company on a going-forward basis.
It's interesting. I didn't realize, Maxim, that it was up to 28% on the nuclear side. But can you give me sort of your view now, because I'm interested, I got you on the line here, is within the group, because we invest in other companies, WSP Global, Atkins Realis, there's, maybe a long, it's Bird Construction, obviously a long shot like North American Construction. How would you rank them right now, which, and relatively?
So right now, the market is excited about nation-building projects in Canada. The market is also very mindful in terms of potential AI disruptions. So what we're actually seeing is a fund flow dynamic, which is privileging actually construction entities versus engineering. And actually, if you look in terms of the multiples, we're seeing this for the first time in history, where construction companies are trading at high multiples versus engineers. So, obviously there was a debate in terms of, how sustainable that is. And whether the AI disruption, I mean, you were in the previous segment, you were talking about software, et cetera, to which extent that could be disruptive or actually an enabler. When you speak to, management teams of engineering companies, they do believe that it's much more of an enabler, which we do agree with, but nevertheless, market's perception is market's perception. So I would say that in terms of if, somebody was looking to ride sort of the more obvious trend, I would have to say that construction right now, especially because it's most levered to Canada-specific dynamic, without kind of going into detail around sort of funding potential issues in the U.S. when it comes to large projects, given sort of the Iran situation, et cetera. So construction for us is where we would be deploying incremental capital in addition to the equipment distributions.
Just want to get in one last question before we go, Maxim. The recent acquisitions, Duna, KPC, how is that playing out?
Yeah, so I mean, they just announced these transactions, so they haven't started really to contribute material revenue for the time being. But what is important is that it aligns with the company's strategy to buttress their utilities exposure. So it's very much in line with the strategy, and hence the reason for such spectacular growth that we've seen from the company over the last 12 months.
Okay, we have to wrap it up there, but Maxim, thank you as always for joining us.
My pleasure.
Maxim Sytchev is Industrial Products Managing Director at National Bank Capital Markets. Still ahead, we'll discuss some market drivers with Bloomberg's Divya Balji, including what's weighing on shares of Robinhood. And of course, our phone lines are open. John Zechner is taking your questions on North American large caps. Reach out, 1-855-326-6266. And you can also email us, first call at bellmedia.ca. All right, I'll look now at some early market movers, and for that we are joined by Bloomberg's Divya Balji, managing editor for breaking news in the Americas. Divya, always thank you for joining us, and let's talk a little mimosas, no champagne corks popping at Pernod.
None whatsoever. This deal that they had or that they were working through or discussing with Brown-Forman has now been officially terminated. This is a bit of a surprise, I guess. It's not surprising that sometimes deals fall apart, but I think there was a lot of hope that these two companies would come together in the current environment that they're in, where there's not a lot of growth in the market that they're in. They're also facing a lot of macroeconomic concerns as well. But now this deal is over. The talks have terminated, and both of the company's shares are down trading this morning. Now, perhaps everything happens for Riesling, if I can say that. There is still Sazerac. There's still Sazerac in the background. They were looking at buying this company as well, or the possibility of a combination. Could they come back into the picture? That is one thing. JP Morgan has already downgraded Brown-Forman's shares to a sell equivalent rating. They're just saying they just don't see the possibility of strong earnings growth at this point without the deal. They also see a lower probability of a deal or a formation with Sazerac as well. So not a good day for Brown-Forman or Pernod as well.
Okay, but Pernod, if they merge with Starbucks, you could have a nice Irish whiskey. Starbucks earnings.
Yeah, this one, I would say investors have certainly perked up over their earnings results that they announced yesterday. If you look at it, they've boosted their forecast for their comparable sales figures. What analysts are actually pointing to here is the optimism around higher demand, more foot traffic in their cafes. If this is clearly a must-have for consumers at this point when it comes to coffee or other types of caffeine-related beverages. In this case, I think there is a little bit of cautious optimism when analysts are writing through and looking through these numbers. They are very happy to see that boost and those strong numbers, but they are a little concerned about margin recovery. Is this actually going to happen for them? Will this be prolonged for Starbucks? Is it just a one-time thing? One of the analysts in particular, I believe it was Morgan Stanley, was just saying that, this could possibly be something that we have to continue to pay attention to into the second half of the year and see if they can actually follow through with these numbers.
All right. Last up, Robinhood taking a hit right now.
Yeah, I think the stock is down about 10% in pre-market trading at this point. I believe it's their net revenue that missed expectations. They've come out to talk about, how they were tapped for the Trump accounts, for these accounts for children that Trump had talked about before and had put forward in that big, beautiful bill that went through Congress as well. They're saying that they will need about $100 million more in additional investment specifically for this cause. Now, that's obviously putting a little bit of pause when it comes to what the analysts are saying. Margin recovery keeps coming up. The current macroeconomic environment that we're in as well is a cause for concern for Robinhood. So not a good day down. Shares are down 10%.
All right, we'll leave it there. Divya, thank you as always.
Thank you.
Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Celestica. All right, let's take a look at some of the notable analyst calls and recommendations. TD Cowen has upgraded its rating on Celestica to a buy with a price target of $430. The upgrade was prompted by a post-earnings pullback in the stock, which TD Cowen viewed as a favorable opportunity for investors. The move follows Celestica's announcement yesterday that the company materially increased its fiscal year 2026 guidance, projecting $19 billion in revenue and $10.15 in adjusted EPS. Spotify raised to a buy from neutral at Rosenblatt Securities with a price target of $500 US. Despite a recent dip in shares following Q1 2026 earnings, Spotify has seen high growth in revenue and premium subscribers. Earlier, they had seen that in 2026. Now, Raymond James initiated coverage of Chartwell Retirement with a new strong buy. Chartwell Retirement Residence is experiencing strong bullish sentiment from analysts this year, with several upgrading their outlook based on record occupancy levels and strategic acquisitions. And when we come back, John Zechner will take your questions on First Call. All right, time for First Call, and that honor belongs to Scott from Mitchell, Ontario. Scott, how are you?
Great, thank you. My question to you, John, is on CNQ. Because of the price of oil that's gone up recently, I'm just wondering if that will be reflected on their earnings coming up May 7th. And if it has it already been baked into the price of the stock? The other question is, I heard that CNQ was possibly taking over Tourmaline. Do you share some color on that? Thanks so much. I'll hang up.
Yeah, I had not heard them going after Tourmaline. That would be a bit of a surprise. Quite a bite for them. It wouldn't fit in with typical transactions they've done in the past. I hold both, so I wouldn't mind seeing it. But having said that, there's no layup ever in the stock market. But boy, CNQ right now, with 4% plus dividend yield, and the stock has pulled back a long way from where it did. I think it got up to 68 or whatever when the war started. I think it's still the dominant player. They show great shareholder returns. They got a huge backlog, in terms of supply length. And it's just, they are the preeminent Canadian play, particularly in oil. So, yeah, stick with it. And, yeah, whether, the price hits the current quarter earnings, I don't know necessarily. You got a month of that maybe into the first quarter, but it will going forward. And the back end curve, like we were talking about earlier, is strong. So, yeah, I'd stick with it. It's a great story.
All right, let's get back to the phones. And up next, Daryl from Nanaimo, BC. We were just talking about Nanaimo. Daryl.
Yes, good morning, John. Thank you for taking my call. My largest holding is ARC Resources, nearly 10,000 shares in a non-registered taxable account. Would you accept the deal going forward that Shell has offered, considering the fact that I will lose my dividend tax credit with Shell being a PLC? And would you go for it, or would you just sell now? Thank you. I'll listen to your answer.
Sell now. Good on you for having, that's been a great story, and it was underappreciated, and you should recognize that a lot of that in the past week, obviously. Mm-hmm. So yeah, I would take the money off the table, and in terms of dividend and other investments, we've talked about a few: Cenovus today, CNQ. Move it into other names in the Canadian sector, but I don't think the upside in ARC. First of all, what if something happened with the deal? I don't think it will and fell apart. You've got a lot of downside there. I don't think another player is coming in to up the bids. So just take that same money and move it elsewhere in the Canadian oil sector. And like I said, we've mentioned a lot of different names that make sense in here, and you can still replace some of that dividend yield. Like say Whitecap, CNQ, Canadian Natural, Cenovus, all
right.
good names. 2
All
million, yeah.
Let's sneak in one more email before we run out of time here. It's from Craig. My understanding is Barrick Mining intends to split into 2 entities this year based on today's price. Do you see it having upside potential?
Yeah, that's a great question. We own it right now. We had been buying it. I like they're sort of cleaning up their operations over the last year in particular, and they're looking like a better play than they have in a long, long time. That North American asset is going to get a premium valuation. My worry is a little bit who's going to be buying the international assets, because suddenly when you look at their international package and Mali's a bigger part of it than it was before, so, it's going to get a real discount. So I'm going to continue to hold Barrick, and I'll see when the pieces split out and decide, which one we'll continue to hold with. But I think, I like the goals in general, and I think Barrick is probably a good second large cap play next to Agnico, and certainly, for Canadian investors.
All right, we'll wrap it up there. John, thanks as always for joining
Thanks,
us. Always a
Arthur.
pleasure, sir. That's it for us here on The Street. Again, thank you to John Zechner, chairman and founder of J. Zechner Associates, for joining us today. And he's up with the open next. Trading gets underway in a little more than 30 minutes from now. Have yourself a great day.